Hey guys, welcome back to part 2 of our 4-part series. This one is Mechanisms of Extraction. Once the infrastructure transitions from public service to investment assets, its operational logic, the logic changes fundamentally, as the public utilities traditionally operate under cost of service models, meaning rates are set to recover operational expenses, debt obligation, and prudent capital reinvestment. Profit maximization is not the core objective. Continuity and affordability are. Private infrastructure funds, however, are whoever are evaluated based on internal rates of return. The investors expect consistent cash flow, often in the range of 8% to 15%, depending on leverage and market conditions. Achieving those returns requires disciplined revenue growth and cost containment. Excuse me. The revenue growth typically occurs through rate adjustments after acquisition. The operators may petition state utility commissions for rate increases justified by infrastructure investment needs. Inflation or acquisition-related costs, in some cases, the acquisition premiums themselves can be incorporated into the rate base, meaning customers effectively finance part of the purchase price over time. While regulatory bodies review such increases and the approval frameworks vary significantly by state, some commissions apply strict scrutiny and others emphasize ensuring the capital availability for the system upgrades. The cost containment frequently focuses on labor and maintenance. Labor represents one of the largest expenses in the utility operations. Private operators may consolidate service centers, reduce staffing levels through attrition, and outsource specialized functions or centralized administrative tasks into the regional hubs. Now, while these changes can produce measurable short-term savings, they may also reduce the institutional knowledge and the local representativeness. There's also deferred maintenance, which is another documented phenomenon in infrastructure finance. Capital-intensive replacements, such as large diameter pipe segments, pumping stations, or vehicle fleets, can be delayed within regulatory tolerance ranges. From an accounting perspective, postponing capital expenditure improves near-term cash flow and return metrics, and physically, however, infrastructure ages. While not every private operator engages in the aggressive deferral, the incentive structure exists because quarterly performance and reporting influences investors' confidence. The financial engineering further amplifies this extraction mechanisms. Revenue streams from utility billing can be securitized or used as a collateral for refinancing. The debt layered onto acquired assets may increase the leverage, enhancing the equity returns as long as cash flow remains stable. Now, this practice is not unique to utilities. It is common across infrastructure sectors globally. Yet, when applied to essential services, it intertwines the community survival systems with global capital markets. Leaseback agreements often include restrictive clauses that limit municipal authority, and early termination may require compensating the operator for the projected future earnings, and the rate adjustment mechanisms may be contractually embedded. Arbitration venues may be predefined, and the result is that the local officials can find themselves bound by agreements negotiated years prior, with the limited flexibility to respond to political pressures. Extraction in this context does not necessarily imply illegality or immediate degradation. It refers to the systemic redirection of surplus revenue above the operational costs toward the investors rather than reinvestment or rate stabilization. Over the decades, what redirection can reshape both financial outcomes and public accountability structures as well. And as we move into part 3, we will be discussing the human cost of efficiency, which goes hand in hand. So thank you for watching another episode of the Political Lens podcast, and we'll see you in part 3 tomorrow. Thanks for watching. Peace.